The National Stock Exchange is moving toward a public debut with a valuation exceeding $60 billion, aiming to raise approximately $3 billion. However, the internal distribution of these funds follows a specific rule. The exchange itself is not retaining any of the capital raised. In a typical initial public offering, cash flows from the public into the company's treasury. This capital is then used as fresh funding for infrastructure, expansion, or new operations. The NSE structure is different. It is designated as a 100% offer for sale, or OFS. As the documentation shows, this results in zero fresh capital entering the NSE's balance sheet. This specific structure indicates that the listing is not a fundraising effort for the exchange, but a reorganization of existing ownership. The IPO capital flows instead to the current owners. Major institutional shareholders, including the State Bank of India, MS Strategic, and CPPIB, are the entities divesting their stakes and receiving the $3 billion payout. While those entities exit, the Life Insurance Corporation of India is taking the opposite approach. It is retaining its entire 10.72% holding, making it the largest individual stakeholder after the listing. By maintaining this position, LIC is effectively keeping billions of dollars in equity anchored within the exchange, rather than cashing out. This confirms that a 100% OFS functions as a liquidity window for early institutional backers, rather than a corporate growth event. This setup creates a logistical hurdle. If the NFC is the platform where India's stocks are traded, where can the exchange list its own shares without managing its own order book? The solution is a regulatory requirement called cross-listing. To prevent a conflict of interest, the NSE must list its stock exclusively on a different exchange. This means that every trade of an NSE share will take place on the systems of its primary competitor, the Bombay Stock Exchange. Regulations prohibit self-hosting to maintain market integrity, requiring even a dominant exchange to utilize a rival's infrastructure for its own secondary market. The pathway to this listing has been unusually long. The original filing took place in 2016, a decade before the current 2026 target. Governance concerns led to a multi-year regulatory hold. This stopped the standard IPO process and forced the exchange into a period of compliance restructuring. To move past these final hurdles, the exchange must secure a No Objection Certificate, or NOC. The authority to grant this clearance sits with the Securities and Exchange Board of India. For foundational market institutions, regulatory compliance and institutional clearance dictate the timeline more than market demand does. This chart places the NSE's 28,000 crore goal into context as the largest proposed offering currently in the pipeline. While a potential Jio IPO might reach a 35,000 crore benchmark, the NSE's trajectory makes it the largest active candidate for India's biggest listing. This case study highlights three specific mechanics: the use of a 100% OFS for institutional exits, the necessity of cross-listing on rival exchanges, and the requirement for an NOC from the regulator. Understanding these structural requirements shows how exchange-level liquidity events function beyond the headline valuation.